The most valuable company in the world makes most of its money selling iPhones. But over the past few years, Apple has slowly diversified its operations to take advantage of its hardware dominance. And this diversification has been executed mainly by focusing on services. Services now make up a record 26% of the company's total revenue. And if you've been following Apple for a while, you might have noticed that the company is getting more involved in the financial services industry. Depending on where you live, Apple now provides services that handle everything from contactless payments to savings accounts. These services are the result of a decades-long strategy to expand Apple's already impressive ecosystem and take advantage of a growing fintech market. Let's dive into more detail. This is the Wallet app. It was launched in 2012 and back then it was called Passbook. This app was initially designed to hold boarding passes, event tickets, coupons, and store cards. What started as a simple digital wallet to store non-financial documents has now become the focal point of Apple's financial services strategy. This is because over the past decade, Apple has constantly added new features designed to turn the Wallet app into a thriving financial and banking service. It all began with Apple Pay. In the years prior to 2014, major card networks were pushing the EMV standard. This was a global standard for credit and debit payment cards based on chip card technology. The EMV standard covered the interaction between chip cards and payment terminals and was designed to enhance security and global interoperability. It essentially improved on the safety of the magnetic stripe cards by making it more difficult to clone the card and by adding better verification systems. This technology gave rise to contactless payment cards. To Apple, this contactless payment wave presented an enormous opportunity because by adding an NFC chip to their iPhones and leveraging the EMV standard, they could essentially turn their devices into contactless cards. The company officially launched Apple Pay in 2014, and the timing could not have been better, considering that merchant adoption of contactless payments increased by 872% in 2015. Next came peer-to-peer payments. While peer-to-peer transactions had existed for a while, they became more mainstream with the launch of P2P apps like Venmo and Cash App. Venmo was a text message-based payment system which launched in 2009, whereas Cash App, which launched in 2013, allowed users to send money via email. But these services became really popular when they transitioned to mobile-first platforms by launching smartphone apps. And by the mid-2010s, both of these platforms were seeing growing number of users. Looking to take advantage of this growing market and expand its presence in the digital payments industry, Apple launched Apple Cash in 2017. Apple Cash is a digital card that lets users send and receive money through the Messages app on their iPhone, iPad, or Apple Watch. So far, Apple had only dabbled in the world of digital payments. But it was in 2019 when the company made its first bold move into the broader financial services market with the introduction of Apple Card. The Apple Card, which was created in a partnership with Goldman Sachs, is a credit card that integrates with the Wallet app. Users can track their spending, make payments, and view their account balance within the app. The app also offers clear payment options, including suggested payment amounts to help minimize interest charges. A straightforward application process, no fees, and some unique user interface features made the Apple Card a success, which is why Apple used this card to expand into more banking services. The pandemic of 2020 resulted in a surge in online shopping, which then led to a growing popularity for financial services that allowed people to split purchases into installments. These were known as Buy Now, Pay Later services. By 2022, there were approximately 360 million BNPL users worldwide, making it the next best addition to the Apple Wallet. In 2023, Apple launched its own BNPL service called Apple Pay Later. This service allowed users to split purchases into 4 payments spread over 6 weeks with no interest and no fees. Users could easily track, manage, and repay their Apple Pay Later loans in one convenient location in Apple Wallet. The company used a wholly new owned subsidiary, Apple Financing, to handle lending and credit check services, meaning that it was the first time the company handled financial services such as loans, risk management, and credit assessments on its own. Then, in 2024, Apple announced Apple Savings, a high-yield savings account with a 4.15% APY only available to Apple Card users. As we can see, financial services have become very important to Apple's strategy. The company is constantly introducing new, more advanced financial products. But why? Why did Apple choose financial services as its next target market, and why is the company investing resources into expanding its presence in this industry? As mentioned previously, Apple has been allocated more focus to its services as its next avenue of growth. And this could not have come at a better time, considering that Apple hardware is having a relatively hard time. Apple revenue from hardware sales has been declining over the past 2 years. In fiscal year 2023, Apple sales dropped by around 5.7%, and a similar decline can be noticed for the first 3 quarters of fiscal year 2024. On the other side, revenue from services has been hitting all-time high after all-time high. And for a company that wants to expand its services offerings, the financial services industry makes perfect sense. The global financial technology or fintech market was valued at more than $294 billion in 2023, and it is projected to grow to more than $1.1 trillion by 2032, representing a huge revenue opportunity for Apple. But Apple's push into this industry is not just about new revenue sources, it's also about protecting its current hardware market share. If the only Apple product you use is the iPhone, then it is relatively easy for you to switch smartphone brands. You just buy the smartphone that gives you the most bang for your buck. However, Apple wants to make it as difficult and inconvenient as possible for you to switch smartphone brands. And making you use other Apple products is one way to do so. In theory, the more Apple services you use, the less likely you are to stop buying iPhones in the future. Think about it. If you use Apple's financial services, a huge chunk of your finances will be intertwined with your iPhone. So, if you depend on Apple Pay to handle contactless payments, on Apple Cash to send money to friends and family, and Apple Card to purchase more expensive items, then you will, in a way, be tied to the iPhone because these services are exclusive to the iPhone. This, in turn, means that when it comes time for you to upgrade your smartphone, you will likely still stick with the iPhone no matter what the other brands offer. This ecosystem is also powerful in acquiring new customers, which is why it has become Apple's primary customer acquisition strategy when it comes to its financial services. There are an estimated 1.46 billion iPhone users worldwide, and as with almost anything else it does, Apple takes advantage of the control it has over its devices to push financial services on its users. You will find ads for these features in your Wallet app, which integrates them in a way that's more unique than compared to Apple's competitors. For example, the Apple Credit Card has a dedicated control panel in Apple Wallet, whereas other cards only display past transactions. Apple also makes sure to link all of these services to each other. To open an Apple Savings account, you need an Apple Card, and to get an Apple Credit Card, you must have an iPhone. This seamless integration makes the products exceptionally user-friendly and consequently more appealing. Say you want to buy the new iPhone 15 Pro. When you go to buy it, Apple is there waiving interest-free payments and a 3% cashback if you sign up for an Apple Card and use it to buy the iPhone. You are approved quickly and can start using the card immediately after you add it to the Apple Wallet. Since the Apple Card gives you extra cash if you use it with Apple Pay, you start using Apple Pay more often. Within the Wallet app, you then see an advertisement for an Apple Savings account. Apple says that you can sign up to have your Apple Card's cash rewards automatically deposit into the savings account, which earns a yield of 4.15%, helping you grow your savings. As we can see, Apple uses a very linear strategy when it comes to signing people to new services, and this strategy relies heavily on its physical products like the iPhone. Apple's brand and dominance in the hardware market is also what the company uses on the supply side of this equation. Apple's push into more sophisticated financial services was done by leveraging partnerships with already established players in this industry, and this makes sense. Apple is not a bank, so it does not have the licenses and crucially the infrastructure to support all of these products on its own, which is why it partnered with Goldman Sachs for the Apple Card and Apple Savings. When the partnership was announced back in 2019, it made a lot of sense for both parties. Apple would get the entire infrastructure to support the Apple Card without having to actually build it, and Goldman Sachs would jumpstart its entry into consumer financial services. While popular among consumers, the Apple Card posed several challenges for Goldman Sachs. According to reports, Apple ran ads saying that the card wasn't from a bank, irritating certain Goldman executives. Apple has also pushed for nearly all applicants to get approved, pushing up loan losses for Goldman. Apple has also insisted that cardholders get their bill at the beginning of the month, which has overwhelmed Goldman customer service employees with cardholders' calls. Most card programs send cardholder bills on a rolling basis to avoid such chaos. In addition to this, Apple had typically requested a literally no-fee card, meaning a lack of chargeable fees such as annual, late, over-limit, and foreign transaction fees. All of this made the Apple Card costly for Goldman Sachs, which has reportedly lost billions on this program so far. Despite these discouraging partnership data points, in October 2022, Goldman doubled down by renewing the consumer finance partnership through to 2029. But just a year later, Goldman seemingly began to regret the renewal and told Apple that it is looking to offload this partnership to another financial institution. And in November 2023, the Wall Street Journal reported that Apple had sent a proposal to Goldman to exit from the contract in the next 12 to 15 months. So where does this leave Apple? Well, some say that Apple might be trying to do some of these things by itself. And this is not far-fetched, considering that Apple was already working on bringing some financial capabilities in-house back in 2022 through an initiative coded as Project Breakout. This multi-year plan included developing Apple's own payment processing technology and infrastructure, along with enhancing risk assessment, fraud analysis, credit checks, and customer service functions such as dispute handling. This shift would potentially enable Apple to offer new financial products and services directly to customers, including first-party credit card processing. Now, the ultimate goal was to create a comprehensive, privacy-first financial services ecosystem that integrated with Apple's existing products and services, offering a unified experience for users. This could potentially expand Apple's footprint in the financial sector and allow it to offer services such as checking accounts, savings accounts, and investment options in the future. But bringing these capabilities in-house is challenging, as proved by Apple's BNPL program. Less than a year after launching its in-house BNPL program, Apple Pay Later, Apple announced it was shutting it down. The company said it will now offer customers payment plans through third-party credit and debit card lenders. Specifically, Apple announced that it would be partnering with banks, including Citi in the US, HSBC in the UK, and ANZ in Australia, to offer installment payment options. This suggests that Apple's plans to go solo have taken a step back, which means that Apple will likely try to replace Goldman with another financial institution that can handle its needs. Apple's moves into the financial services market have not gone unnoticed by the legacy players in this industry. JP Morgan Chase CEO Jamie Dimon has referred to Apple as a bank, highlighting the tech giant's growing presence in the financial sector. And as Apple's financial offerings continue to expand, industry leaders like the American Express CEO admit to feeling paranoid about the competition from tech powerhouses like Apple and Amazon. Banks are specifically concerned about Apple Wallet. The thinking is that as more people use Apple Wallet, they will stop using bank cards. This effectively makes Apple the only company the user interacts with while paying for something, eliminating the relationship between the bank and the users. Banks fear that this will leave them vulnerable if Apple does decide to become a more important player in this industry, which is why they are trying to fight back. Early Warning Services is a privately held fintech company owned by 7 major US banks: Bank of America, Capital One, JP Morgan Chase, PNC, Trust, US Bancorp, and Wells Fargo. This is the company behind Zelle, the peer-to-peer payment program that directly integrates in your banking app. Zelle was created to challenge other P2P payment platforms like Venmo, PayPal, and Cash App, and to bring some control of this market to the banks. In early 2024, Early Warning Services launched the Paze Wallet, a digital wallet for online payments. It works similarly to PayPal, meaning that when buying something, you can select the option to check out using Paze. Then, you simply enter your email address and select the card you want to use to pay. This way, you do not need to enter your card details manually or download a third-party app. Paze was created as a way to compete with Apple Pay when it comes to online payments. The thinking is to offer a product that reduces how many people use Apple Pay, which should theoretically weaken any future Apple financial services. But whether Pays will be successful will depend on a host of factors, more important of which is the number of merchants and customers that will adopt it. So what is Apple's future when it comes to financial services? Well, the company will probably start offering more services in the short term. Apple has made it clear they want to focus on products designed to improve the lifestyle of its customers. In 2023, Jennifer Bailey, the VP of Apple Pay and Apple Wallet, said, "Our goal is to build tools that help users lead healthier financial lives, and building savings into Apple Card and Wallet enables them to spend, send, and save daily cash directly from one place." Based on this focus on healthy financial lives, it is reasonable to expect that Apple intends to develop a suite of tools that allow people to control, manage, and optimize their finances, similarly to what the company currently offers with its health app and data. While Apple will want to expand its financial offerings, it does not want to become a bank itself, at least not in the short term. Offering more sophisticated services like checking accounts, savings accounts, loans, and mortgages requires licenses and complying with very strict regulations, something that Apple can bypass by simply partnering with established institutions that are already licensed and already comply with these regulations. In another scenario, Apple might not even be allowed to use partnerships to expand into more financial services. Apple's ecosystem strategy creates an environment that may make it challenging for users to leave. This raises questions regarding potential monopoly issues, which could draw the attention of antitrust regulators like the Federal Trade Commission. Should Apple's financial services significantly disrupt the banking sectors, regulators may scrutinize its business model more closely, while the company must also ensure that consumer data usage does not trigger antitrust concerns. All in all, Apple's future when it comes to financial services is still up in the air, and it will be exciting to see where the company heads.